you deal with. So what I'd observe again from my time at Society One is we ended up doing partnership deals with a lot of the building societies, credit unions, in the same way as Lending Club did in the US. And they typically did orders of magnitude less due diligence than a CBA or SPAC or somebody would do. And on the one hand, it's not how any of the big four would or should deal with their counterparties. You know, as you say, they've got systems and reputation and data and everything to protect. On the other hand, that means they can't move quickly and they can't expose themselves to the sort of things that the credit unions are getting incredible experiences and learnings from that, you know, the banks are depriving themselves from because of the way that they have to interact with their counterparties. So it's a bit of a two-edged sword. I don't have an answer for you.
I might just jump in on the first part, because the second part I have no idea. But the first part, I think, in terms of the partnership, privacy data, those type of issues, there are always ways to kind of manage where that sort of the firewall kind of issues are in terms of who actually sends out emails, or who does kind of which part of the testing, or which part of the engagement with the end customer, and so that you're not sort of exposing that sort of material. The other big thing which we say to people is try it out with the smallest sample possible before you go for the whole thing, for a number of reasons. Firstly, see what the system how the system can handle the volume, or can handle the testing, and just don't use small sort of subgroups, and rather than kind of go for the full big bang. Now, the startups always want to go for the full big bang because they go, well, if I can do it here, then I can do it there and there and there. It's like you learn along the way. So I think that's an important thing. Is, you know, take it sort of piece by piece. In terms of the actual who to partner with, most of the time these businesses don't have a track record. You can't spend hours and months on a data and doing due diligence. Your due diligence has to be around the people. Are they fundamentally honest, good people who know what they're doing and have got the right idea? Are they open to listening to input and experiences, or do they know it all? Are they people who one of our less than enjoyable experiences, that the first thing that one of the founders did after we invested, and this is not at the outcrowd level, the first thing they did was they said, we're going on a sales conference, and they flew themselves business class to New York, and you're going to think, I know how they've just funded that. So what's the culture in terms of their mentality? Not that we want them sort of sitting in a cold garage eating pot noodles for 2 years, but we've had people do that. Like, what is their intent? What's their drive? And you spend so much more time with the management team. It's like a marriage. You spend so much more time with the management and getting to work, understand how they operate, rather than poring over is the legally binding contract going to give them 14 days notice or 21 days notice. That's not how a business is going to be successful. It's about the people. The final piece of that, and then I'll be quiet, is we see a lot of businesses where they try and raise too much too early on. Now, the impact of that is that the founders don't have enough ownership of the company. And so we're very, like if in the first real round that they're going for, if the founders don't have somewhere between 40 and 60% ownership, that's a worry for us, because it will take longer, cost more, they'll need to do another raise. And if the founders don't have enough equity position in the company, that they're not, at a certain point they're going, hang on, I'm being paid a third of my regular salary, and which is pretty much a must. They should be being paid a third of the regular salary. I don't own enough of this business. The risk weighting is not there enough. So I laugh when I watch things like Shark Tank, which I think is amazing. But like, these guys get screwed over by people for ridiculous amounts, when they should actually, the shark should actually be saying, we want you to own as much of your company as possible.
That's true. And I think, look, it's a really interesting question. Any of you thinking of doing any further research? I think that this partnering model, there's a lot of unknowns in your question yet to be uncovered. Another question.
Thank you. Hi, my name is Rebecca. I have a question for Simon. You mentioned earlier about what brought up the P2P. So, as insider of the global P2P communities, can you share your thoughts if there's any variations in the major P2P market in the world, for example, in US, in China, what brought up the P2P in US, in China, if there's any difference?
So you're asking what were the factors that led to the rise of...
Yeah.
So if I look at the US and China, I think what enabled the P2P markets to flourish in the US was the GFC, and all of the major banks, almost without exception, were hit in the US, and they all pulled back from personal lending. So there was a massive hole in the market for personal loans, and the P2P lenders filled the hole in that market by providing a platform for other investors to come in who weren't capital constrained like the banks were to offer that product. And once they had that foothold, they could grow very quickly, and ultimately they've replaced personal loan products in almost every major bank and building society in Australia, in the US, because they managed to get a foothold at a much lower margin than the banks were able to sustain. What led to the rise in China, I think, is a lack of regulation and legal system, combined with investors looking for yield. And so you had this explosion of P2P platforms, literally thousands of them, with no transparency as to the assets underneath them, and some of them have just vanished, like Isabel, which was like a $10 billion Ponzi scheme, and you have platforms taking advantage of the lack of sophistication, lack of transparency to offer a product that might or might not be there. And I think so. You have two very, very different factors in the two different markets. One a highly regulated and legalistic market, and the other, highly unregulated and legalistic market.
Yeah, what about the good ones? I mean, I know there is some incident happen in the P2P market. What about the good one? There are still some good companies still exist in the market. Do you think for the same reason?
Investors are looking for yield.
For yield.
Fundamentally.
Okay.
Okay, excellent. Thank you. Another question over here.
Richard, my question's for you. Maybe a bit technical. So, Bitcoin is for practical effects fixed supply. So I guess my question is around, what do you see in the crystal ball, going forward? And there's much discussion about, Bitcoin. They say it's associated with a lot of illicit activity and what have you. At the same time, you've got the Reserve Bank saying they're interested in digital currencies and blockchain solutions. From what you're saying, I also get the impression that there are other applications around blockchain. So now we have the election. There's discussion about this blockchain system to verify votes and what have you. So the question is, what do you think will happen with Bitcoin? And what other significant application from there that may not be related to the finance industry do you see as most interesting and promising?
Okay, as for the first part, I honestly don't know. If I was to take a guess, whether it's Bitcoin or some alternative which is based on a similar kind of technology, it's already proved that in the marketplace it has some value, so I don't see it going away. But what form that will take will probably be quite different between now and even 5 or 10 years' time. There's the technology is evolving so rapidly that it's actually very hard to say. What is probably a bit easier for me to comment on, though, is the second part of your question, which is the other areas of the market which are based around blockchain. So blockchain, people associate it with Bitcoin, but really what it is it's a distributed ledger of transactions, and that can actually apply far more broadly than cryptocurrency. When you want to look at, you mentioned one of the use cases around elections, any form of system where it requires trust between different parties is a potential candidate for blockchain to be applied to. So certainly the health industry is looking at it, for example, in terms of maybe giving people ownership of their own health records to a degree, and then giving that to the appropriate health provider at the appropriate time. One of the other areas I see it's being used in is supply chain. It's much less regulated, say, than the financial industry. There are a number of different parties involved, and they require a level of trust with one another, and that can certainly be some advantages in terms of things like provenance and traceability. For example, if you buy a pharmaceutical product, can you guarantee where the manufacturer was and what steps it's gone through? In the financial services industry, I primarily deal at the big end of town with areas like application of blockchain around mortgage-backed securities. Trade finance is another very big area that we're currently looking at. International payments is another area where it can be applied to. So again, nothing to do with cryptocurrency even in terms of payments. We're not actually looking at it as a currency, but as the shared ledger aspect of it being applicable in those areas. So I think blockchain is much bigger than what Bitcoin is. Where Bitcoin's going to go, I'm not so sure.
Okay, another question. Did you have a question? Yeah. So just before I answer, it seems to me that whatever's going to happen to Bitcoin or blockchain, the trend seems to be two-syllable words that start with B. So whatever's going to come, it'll be the next one. Yeah. What's your question, please?
Hi, Peter from the AGSM MBA program. My question's directed at Josh and Simon, and I'm wondering how you see crowdfunding for equity and also around the P2P debt finance interacting with the funding options available to startups, angel investment, VC, and corporate VC?
I would tend to see crowdfunding, peer-to-peer lending as fundamentally doing the same thing for different parts of the market, which is they're fulfilling three things. They're providing a platform to match buyers and sellers of financial products, be it debt, equity, VC, angel, wherever it is on the spectrum. It provides some sort of vetting or underwriting process. Josh was talking about earlier, our crowd contrasting to the newer startups, where our crowd provides that sort of vetting process and the newer ones don't. Similarly, in peer-to-peer lending, the early incarnations of peer-to-peer lending platforms saw themselves as sort of the eBay of loans, and anyone would put any loan up and people would bid to fund a loan, and they found that those sort of platforms crash and burn very quickly because retail arm's length investors can't really do the due diligence on a loan, or I'd say equity investments that's required. You need to be much closer to it. So the platform has to play that role as well. And then there's some sort of ongoing management, whether it's loan management or investment management, that again the individual investor can't undertake. So you've got I've sort of thought about this a lot. You've got a common structure wherever you are on the capital spectrum, but the platform is playing certain sort of similar roles, along that spectrum.
From a company's perspective, I think it all kind